Here's a summary of the CVS Health second quarter 2026 earnings call transcript, focusing on key financial metrics, management forecasts, risks, and important statements. Introduction and overall performance. CVS Health reported a strong second quarter of 2026, exceeding expectations across all operating segments. The company generated $5.2 billion in adjusted operating income and $2.58 in adjusted earnings per share, EPS. This robust performance has led CVS Health to raise its full-year 2026 adjusted EPS guidance by 60 cents to a new range of $7.90 to $8.10. Furthermore, the company is increasing its full-year expectation for cash flow from operations to at least $11.5 billion, a significant $2 billion increase from previous guidance. Key financial metrics and segment performance. Enterprise revenue exceeded $106 billion in the quarter, an increase of over 7% year-over-year. Enterprise adjusted operating income reached approximately $5.2 billion, a substantial increase of over 35% year-over-year. Enterprise adjusted EPS delivered $2.58, a significant jump of over 40% year-over-year. Healthcare benefits and their revenue grew over 3% to over $37 billion, driven by the government business. Adjusted operating income was approximately $2.4 billion, with a medical benefit ratio, MBR, of 87.4%, showing meaningful improvement year-over-year due to strong medical cost management and disciplined pricing, particularly in Medicare. Health services. Caremark and healthcare delivery revenue increased over 11% to nearly $52 billion, driven by pharmacy drug mix and brand inflation. Adjusted operating income was over $1.7 billion, a 10% increase, attributed to improved purchasing economics and pharmacy drug mix. Caremark experienced some pressure in its 340B business, but saw outperformance in other areas, including higher specialty generic penetration. Healthcare delivery revenue grew nearly 23%, largely due to Oak Street Health. Pharmacy and consumer wellness. Retail pharmacy revenue was nearly $34 billion, with modest same-store revenue growth. Adjusted operating income was nearly $1.5 billion, an increase of over 10%, benefiting from core pharmacy strength and contributions from the Rite Aid transaction. Same-store pharmacy sales grew approximately 3%, with a 7% increase in prescription volumes. Management's forecasts and outlook. Full year 2026. Adjusted EPS raised to $7.90 to $8.10. Total revenues expected to be at least $414 billion. Cash flow from operations increased to at least $11.5 billion. Enterprise adjusted operating income projected in the range of $16.58 billion to $16.92 billion. Healthcare benefits adjusted operating income expected between $5.03 billion to $5.37 billion. Pharmacy and consumer wellness adjusted operating income at least $6.4 billion. 2027 preliminary commentary. CVS Health is providing early insights into 2027, anticipating a potential adjusted EPS of at least $8.44, which aligns with current consensus and implies roughly 13% EPS growth from an adjusted baseline. Aetna's margin recovery is expected to continue, with momentum building towards target margins. Pharmacy services faces headwinds from continued market dynamics in the 340B business and anticipated membership declines in Caremark due to deliberate approaches to client renewals and market exits by health plan customers. These headwinds will be partially offset by the industry-leading specialty pharmacy business and secular trends. Pharmacy and consumer wellness is expected to continue its strong momentum, with second consecutive year of mid-single-digit growth. CVS Health remains confident in its previously stated target of a mid-teen adjusted EPS CAGR from 2025 through 2028. Significant risk factors. Forward-looking statements are subject to significant risks and uncertainties that could cause actual results to differ materially. These are detailed in SEC filings, including Form 10-K and 10-Q. 340B Program Dynamics. The environment for the 340B program remains dynamic, with pharmaceutical manufacturers imposing restrictions and large specialty drugs becoming generic, creating program pressure. This is expected to be a headwind in 2027. Caremark membership declines. Anticipated membership declines in Caremark in 2027 are due to a deliberate approach to client renewals and contracting, as well as market exits by health plan customers. Industry-wide trends. Pharmacy reimbursement pressure and regulatory-related price reductions on certain drugs continue to impact the pharmacy and consumer wellness segment. No Surprises Act and Independent Dispute Resolution, IDR. While accounted for, the IDR process is noted as not playing out as intended and appearing to be abused by a small group of players, causing frustration for self-funded employer clients. Litigation. CVS Health is challenging laws in states like Arkansas and Tennessee that could make care more expensive and less accessible. Highlights. Exceeded expectations. Strong performance across all operating segments, surpassing internal targets. Raised full-year guidance. Significant increases in both adjusted EPS and cash flow from operations for 2026. GLP-1 opportunity. CVS Health is well-positioned to capitalize on the growing demand for GLP-1 therapies through affordability, access, and convenience across its Caremark, Aetna, and direct-to-consumer channels. Technology and AI integration. Significant investments in technology and AI are enhancing consumer and provider experiences, improving operational efficiency, and creating new revenue opportunities. The Health 100 platform and AI assistant HEO are key examples. Provider partnership focus. Efforts to simplify interactions with providers, reduce administrative burdens, like prior authorizations, and improve access to patient information are strengthening CVS Health's position. Aetna's margin recovery. Demonstrating significant year-over-year improvement in adjusted operating income, indicating progress towards full potential. Specialty pharmacy strength. CVS Specialty continues to lead with high adherence rates, above 90%, and a tech-enabled approach. Pharmacy and consumer wellness momentum. Strong performance driven by core pharmacy strength, Rite Aid integration, and improved customer service. Strong cash flow generation. Demonstrating robust cash flow from operations, enabling balance sheet strengthening and future capital deployment. Lowlights. 340B headwinds. Expected to be a headwind in 2027 due to industry dynamics. Caremark membership declines. Anticipated membership declines in 2027 present a challenge for the pharmacy services segment. IDR process concerns. The independent dispute resolution process under the No Surprises Act is seen as being abused, creating issues for self-funded employers. Most important statements from CEO and CFO. David Joyner, Chair and Chief Executive Officer. Each of our operating segments grew earnings and delivered performance that exceeded our expectations. Building on this strong performance so far this year, we are raising our full-year 2026 adjusted earnings per share guidance by 60 cents to a range of $7.90 to $8.10. We are best positioned to improve affordability, expand access, enhance the consumer experience, and capture the opportunities ahead regardless of how consumers choose to access GLP-1s. Becoming the partner of choice for providers is such an important priority for us. We spend a great deal of time listening to providers and understanding where they experience the most friction in the healthcare system. Across each of our businesses, The deliberate actions we've taken are strengthening our position in the market and creating opportunities for distinction and long-term sustainable growth. We are doing what we said we would. We delivered strong results, exceeded our expectations, and raised our outlook for the year. More importantly, we're continuing to make meaningful progress towards becoming America's most trusted healthcare company. Brian Newman, Chief Financial Officer. Our strong second quarter results demonstrate the discipline with which we are managing the enterprise and exemplify our say-do philosophy as we continue to execute our strategic priorities and deliver on our commitments. We generated over $106 billion of revenue in the quarter, an increase of over 11% from the prior year quarter. This increase was primarily driven by pharmacy drug mix and brand inflation. We are increasing our full-year 2026 guidance for adjusted EPS to a range of $7.90 to $8.10, an increase of 60 cents or 8% higher than our previous guidance. We are also increasing our outlook for full-year cash flow from operations to at least $11.5 billion, reflecting our updated earnings outlook as well as the impact of improvements in working capital. We are seeing significant momentum in Enda's margin recovery and expect this momentum to continue on our pathway back to target margins over the next couple of years. While we would not normally comment on 2027 consensus this early in the year, an outlook of at least $8.44, consistent with current consensus, appears reasonable at this juncture. This represents EPS growth of about 13% off an adjusted baseline of $7.46. In summary, CVS Health delivered a highly successful second quarter of 2026, exceeding expectations and raising its full-year financial outlook. The company is demonstrating strong execution across its segments, driven by strategic initiatives in areas like GLP-1 management, technology adoption, and provider partnerships. While facing some anticipated headwinds in its pharmacy services business for 2027, CVS Health remains confident in its ability to achieve its long-term growth targets through disciplined execution and leveraging its diversified business model.